We are quite optimistic for the future, especially given the way we see a rolling recession evolving into a rolling recovery and then into a productivity-driven boom in economic activity accompanied by much lower than expected inflation. Well, if we're right and inflation is much lower than expected and interest rates will follow, including mortgage rates, then the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down. That's how you get that psychology. And we think that will be at work during the next few months, if not years.
Hey guys, welcome to Everyday Finance. Solid bull market continues to exist for Bitcoin, which has maintained its stability despite recent global tensions. These tensions include the sell-off that occurred after Liberation Day and the aftermath of Israel's strikes on Iranian nuclear sites. Bitcoin continues to beat gold, demonstrating strength and stability. Despite the fact that geopolitical threats are increasing continuously, the data presented on the blockchain demonstrates a constant accumulation, which suggests that long-term holders and institutions continue to have confidence. Bitcoin's position as a long-term investment is becoming more prominent as a result of the growing demand for exchange-traded funds, ETFs, and the increasing popularity of Bitcoin around the world, according to Cathie Wood, CEO of Ark Invest. The stock market as a whole has shown a similar level of resiliency. The rally is growing across more industries, which is an indication of healthier and more stable growth due to the fact that it is occurring. Despite concerns such as tariffs and slowdowns in certain areas, productivity has been on the rise, particularly as a result of artificial intelligence and other emerging technologies, which have enabled businesses to reduce their expenses and improve their efficiency. This pattern contributes to the control of inflation while simultaneously fostering economic expansion. The true surprise may be lower inflation, improved financial outlooks, and ongoing market gains based on strong fundamentals. While many people anticipate higher interest rates or longer recessions, the real surprise may be more favorable economic conditions. Cathie Wood will explain why Bitcoin and the markets may be entering one of the most revolutionary eras in decades. So, make sure you stay tuned for her analysis.
Mention Bitcoin here, Bitcoin to gold. Gold was gaining purchasing power over Bitcoin late last year into this year, but now Bitcoin has turned and moving back. I know it's threatening new highs. It's been very interesting to watch Bitcoin during this period. It has been acting not as much as gold has, but it's been acting like a risk-off asset. More people are willing to hold it and gold, especially during the market tremor. I know we ended up in a bear market by some metrics during or right after so-called Liberation Day, early April. But Bitcoin has maintained its uptrend relative to gold, did not break. And I think that's a very, very positive thing. Even during the Iran or the bombing of the Iran nuclear facilities, Bitcoin really held its own. So I think it's still in the bull market as our on-chain analytics led by David Puel suggest that we are still in a bull market for Bitcoin. And I do think you can say the same now about the equity markets. A lot of investors were faked out during both the tariff turmoil and that weekend around the war intensifying in the Middle East. and the equity market is powering through all of this. I really love bull markets like this because what's happening is the equity market is climbing a wall of worry. And what's been fantastic about this time around is it has not been an unhealthy bull market like it really was from 23 to 24, when the concentration towards just a few stocks was at its extremes. The market is broadening out, so it's much healthier now while it's climbing this wall of worry. So I think you could say we are quite optimistic for the future, especially given the way we see a rolling recession evolving into a rolling recovery and then into a productivity-driven boom in economic activity, accompanied by much lower than expected inflation. Now, it's very hard to see on a month-to-month basis, but actually in the last few months, the budget deficit has come down slightly as a percent of GDP already. You can see here the green line and X depicts where Treasury Secretary Bessent aims to take the deficit over the next 3.5 years. If our outlook for growth driven by productivity is right, we think he will be successful. So we think that the tide is turning here, and we think the surprises could be on the low side of expectations, meaning the deficit shrinking as a percent of GDP more than people expect. And on the next chart, you can see we featured this last month. The reason we're featuring it again, the corporate tax rate, is it does look that in both the House and the Senate versions of the bill, that full expensing of capital equipment and some structures has made it into the bill, which would take our effective corporate tax rate down into the 14 to 15% range, which will be one of the lowest in the world, certainly in the developed world. And one reason we do believe foreign direct investment will increase in this country.
The money supply is expanding once more, but not at a rate that is causing significant cause for concern. The M2 money supply is growing by approximately 5%. Year over year as of the middle of the year 2025. This is an improvement from the uncommon decline that occurred in 2022, but it is still very low when compared to the rapid growth of 10 to 13% that was witnessed during previous economic booms. Cathie Wood believes that the risk of inflation is still quite low, mostly due to the fact that money is not moving in a rapid manner throughout the economy. The velocity of money, which is a measurement that measures how frequently each dollar is spent, is used to keep track of this gradual movement. That velocity has been falling for decades, and it is currently getting close to reaching all-time lows. Increasingly, individuals and organizations are retaining their capital for longer periods of time, spending less frequently, and placing a higher priority on investments than on consumption. This phenomenon can be attributed to a number of developments, such as the aging of populations, a shift toward saving, and a slowdown in consumer spending. In the event that inflation continues to fall and interest rates continue to fall, there will be even less of an incentive to spend rapidly, which will further reduce the risks of inflation. This climate of low money velocity, along with increased productivity and increasing use of Bitcoin, might define a new period of disinflation and the expansion of digital assets, according to Cathie Wood, who believes that this environment could define its own era.
Here you can see what I mentioned about M2. M2 is closing in on 5% growth. That's depicted in the purple line here. But if you take a look over history at this chart, you'll see that even that rate is at the lower end of what we've experienced over the years. Now, what's also interesting on this chart is in the 60s and 70s, you'll see M2 growth on a year-over-year basis was outpacing inflation. It was accommodating all kinds of government spending. And you can see that this is pushed ahead by 18 months, that if we're right, the inflation rate is going to come down. And the controversy out there, and I think what Treasury Secretary Bessent has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we've just been through the cyclical bump, and velocity is starting to turn down again. So that trend is important. If it's still in place, then money growth at this level is not at all a problem in terms of feeding inflation. The velocity is the rate at which money turns over. And why would it decline? Well, if we're right and inflation is much lower than expected and interest rates will follow, including mortgage rates, then the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down. That's how you get that psychology. And we think that will be at work during the next few months, if not years. Here, again, this has been an interesting test. The S&P to gold. Those who think we have an inflation problem spurred by government spending and deficit spending expected a breakdown like we saw in the 70s. And so we've been testing that thesis here, and you can see there's a triple bottom so far. The S&P is now starting to go up relative to gold. And on the next chart, you'll see what has been the leading indicator there, and that's S&P to oil. And now that we have Saudi Arabia basically saying, yes, we're going to put another 400 to 500,000 barrels on the market, even with oil prices at this level, we think this indicator will continue to move up, which is very much unlike what happened in the 70s, late 60s and 70s. And then here is that long-term Treasury yield. We think that the 40-year bull market is over, mostly because the Treasury yield will normalize. We're not at 0% Fed funds rate anymore, and the market is starting to work again, and that's what we want. We don't want to go back to 1%. But if inflation is going to be as low as we expect, even if growth accelerates, we'll see short rates really responding much more to the growth rate, and long rates tuning in to more to inflation. And if inflation's going to, below 2%, maybe even 0%, as we expect, then the Treasury bond yield should probably drop into the 3 to 4% range. And then just a couple of more. Always look at the high yield spread, so the difference between the high yield, so more junk-like bond yields, and the 10-year Treasury yield near its lows, had a little spike around tariffs, and now moving back down. And so the bond market doesn't have a care in the world. Now, we do wonder if there's just too much capital flooding the credit markets, especially with all these private credit funds. And so maybe the signal is being distorted by that. I don't know. But if it is, that will end badly. And then finally, always have to...
Taking into consideration Cathie's analysis, it is possible that we are about to enter a phase in which reduced inflation and greater productivity will sustain economic development without triggering overheating. This might potentially cause a shift in the way investors think across all markets. Given the current climate, Bitcoin is in an advantageous position. As liquidity returns and traditional assets appear to be overvalued, there is a possibility that Bitcoin will attract another wave of interest from institutional investors. It is possible that capital will flow into Bitcoin at a faster rate than many people anticipate if risk appetite grows and interest rates fall. If Cathie's prediction turns out to be correct, this would indicate that the market is undergoing a more comprehensive reset, which would be characterized by increased efficiency, a reduction in inflation, and a greater role for digital assets such as Bitcoin in long-term investment strategies.